Well, hello, folks. Top Gun here with you, and I got a good one for you today. Everything that you guys want to see in one episode, because you don't want to click on anything else. And all I'll say about all those videos you didn't watch was I gone and done told you. Hey, whales, love your stuff. Uh, or whales only, yeah. So, anyway, yeah, you guys, I make lots of content so far. I'm just pumping it out there, trying to give you guys useful information, and some of it you click on, and some of it you don't. So I'm gonna blast a bunch of useful information in this video. That's right, we got price predictions, we've got LP math, we've got a little bit of swing trading information. This is the math that is preparing me to know what to do on Pulse Chain. Don't swing trade, you're gonna get wrecked. Sorry about the audio. It's Saturday morning. I do have a day job. All right, I don't get paid to do this. I ever got encouraged to make a donation link. Well, not link, but there's a wallet address. 0 donations. I can feel the love. It's good. It's good. I actually kind of creeped out like, if I start making money on that, no. But I mean, I can quit my day job and I can do this full time if all of a sudden I have the money to do it. So what have I done in my spare time for you guys? Why do you guys keep tuning in? Why do you guys care about my math? Well, let's have ourselves a look at that math. So, first off, here. All right, we can go ahead and change this because we know you hate it. We're just going to use hex. All right, this is a calculator that'll tell you the starting ratio of hex. How does it work? Let me show you. What's the price of hex right now? 17.82 cents. Is that close enough? We're just going to go to that. Yeah, I think it is. So we're going to put in that price 0.1827, was it? Uh, 82. Sorry, 1782 currently. Okay. 1782. What's the price of ETH? Let's go back here. Price of ETH. It's 2804. We're not even going to use the cents. Alright, 2804. Bam. You'll notice some numbers have changed. That's interesting. So this is no longer IM to ETH or IM to Pulse. It's hex to ETH and hex to Pulse. So what I'm trying to find out here with these ratios is exactly how many coins you should be getting when these buyouts happen, right? That's interesting. Did I screw up this math? Pause this. I thought I had this all in mind. Sometimes I don't even know how my own math works. Isn't that cute? Alright, yeah. I'm a dork sometimes. Here, so what we need to do is flip these because I wanted to be able to see the pulse to hex ratio, right? Because that's why these numbers are fractional, because IM is worth that little. So yeah, we want well, this will be ETH to hex, pulse to hex. So I'm doing math on the fly, so you can see how I calculate these ratios. So first off, take the price of ETH, divide it by the amount of hex, or vice versa, and this generally tells you the ratios. So here we want to know equals. So we already know the that you can get 1 ETH will get you 1500 hex, but how many ETH can you get with 1 hex? So in this, it'll have to equal this number. divided by this number. Oh, that's pretty small. Okay, so we want to take a look at this the other way around. So this number has been scaled. So to do this, all we have to do, okay, in this case, we're going to be multiplying. So instead of dividing, so this is going to equal the ratio I just found out times the increase in supply. So if the increase in supply is 1.2 million, this is how many pulse should be to hex when the snapshot happens. Now I've heard some different numbers. This is what Richard Hart says. If it's K for K, 1.4 million, that's how it affects the starting ratios. That is as simple as it is. I just did the math for you guys. You find the price of the Ethereum, because that's what Pulse is going to be based on. Find the price of the asset you're looking for, IM, Hex, whatever you're looking for on Pulse Chain. And you can easily divide the Ethereum number by the smaller number to find out how many of the smaller coins you would get for 1 Ethereum, or vice versa to find out how many Ethereum you get for the smaller coins. Then you either are multiplying or dividing that ratio that you get down here by this 1.2 or 1.4 million. It's that simple. And boom, here's your numbers in your different directions. This one's with the division. This one's with the multiplication. All right? It's that easy. So you can see, here's the starting ratios. And if this is the starting ratios, well, gee, if I get less pulse coins for my hex, it's more expensive if I'm only getting 2 pulse coins. That seems like maybe a bad deal to start off. If I'm getting more coins, like let's say 210, maybe that's a better deal. And if I was involved in the sacrifices from day one, the price might be more equivalent to 1,300 coins-ish. This is an approximate I took from someone else. So here's an idea, starting range, bad deal, good deal, great deal. Okay? Look, you just kind of got an idea what ratios based on the starting value might be alright to get in on. Is that the basis for how we swing trade? Oh, and the extra bonus here. So if you are providing liquidity and you say have a coin on another chain and you want to put it on Pulse Chain and you're trying to figure out what liquidity should I set in PulseX, how would I figure out what that liquidity pool should look like? Ratios of the coin to ratios of pulse. And then that's obviously pretty small, so you just scale it. So if you wanted, say, 2 trillion tokens of whatever you're making in that pool, and you wanted it to be, there we go, then it'd have to be that much bigger. So if you wanted to make a giant liquidity pool, that's insanely big. Point is here, you figure out how many coins you want to put in. Well, look, it tells you what liquidity pool you have to pair in. This is, again, assuming your asset is on another chain and assuming it had been part of the buy-up that Uniswap was going to do. So you want to be getting in at fair ratios to how all the other assets will be set in PulseX. This is basically how the AMM math balances. This is another way of looking at it. It's not how the AMM runs, but this is another way of looking at the automated making marker math. Ugh, I'm stuttering. Yay! Okay, folks, this is the base math you need to know to understand the value of your assets and how PulseX figures out what ratios it's going to start at. Does it tell you what the fair value is going to be, where those ratios are going for sure? No. This is just a starting point. Okay. What else can we look at? when we start to look at LPs and LP math? Well, we can ask the crystal ball, what else do you see for us? Well, some other things I've worked on in my spare time. This is an impermanent loss calculator. So in this case, I had set it, I want to set $4 of liquidity, so $8 worth in the pair. This is insanely small. Somebody might come along and go, well, I want to put $1,000 in. And that price actually had gotten all the way up to, what, a penny? So we'll just put it to there. Oh, look, this tells you the size of the LP that you need to produce its initial starting value. And what is this over here? This is the future price, so the current price or current value. I should change price to values. Future value. So if the price goes down, interesting thing about impermanent loss. Yeah, right now the total is 182, and this sucks if the coin had rubbed and you're never getting your money back. But if you had just been part of a market correction, which admittedly are usually only 75%, so that would actually be 0.003. Okay. So in this, you can see if there's a 75% correction dip in an asset, it looks like you lost half the value of your LP. Because you did in the stable coin. That's gone. Basically, you've been buying coin in your LP while the price went down. But you'll notice your pulse bag has doubled. So if you believe in this asset and you think that this is only a stepping stone and that the future price is maybe $1, well, then you have just collected more of an asset, an impermanent gain that will be later rewarded if you can hold. You know, there's only one secret to getting rich in crypto. Everybody gone and done told you. So yeah, hold. So the idea that I had with this is, if a asset is going to go up and down in liquidity, but mostly sideways, lots of volume, lots of fees being made, no impermanent loss or impermanent gains. Just your LP stays about the same, but you make a lot of fees. That's the optimal idea. But how do you know if it's just going to go sideways? You don't. There's usually indicators we're going to start an upward trend or continue a downward trend. Sideways, well, there's not a lot of guarantee on that. So providing liquidity, say, at times when I think a market correction is coming so I can scoop up more of the bag and stabilize the price is the game I want to play with this, but this calculator could be used in other ways. The math is right here. So also you'll see where I've got all these profit calculations. So assumedly, in all this trading, you would collect coins, and the value would be based on the future value. You'd collect coins from both sides of the pool. And if you even have PulseX and manage to win a vote, or just lucky enough to be part of the group voted for, that you have incentive tokens being provided, perhaps those will have a value and you might get a certain number. They looked like they were at 99 cents when I was looking the last time. And, oops, it would help if I used only one decimal, right, folks? And all of a sudden, you can see how the profit starts to really generate out of the fee collection and the incentive tokens, the more that you can earn. So incentivized pools are good. And collecting fees with lots of high volume up and down is good. And providing liquidity at times that you think the market's going to correct in an asset you believe in is probably good. And all this math runs off of one simple little what if game. I've done this math a ton of times for you folks. So x times y equals k. That's it. That's all there is to it. Get a little simpler. Drop that. Now I suppose there's a little more we can say. And if we take x and we divide it by y, that equals the price. So now in mathematics, the moment you have two formulas, So one aspect of the two creates one variable, and the other aspect of the two variables creates a secondary variable. You can use K and P by themselves to figure out X and Y. This is called a functioning set. So now you have dependence. You can actually work these things. And when I do that in Excel, I build a teeter-totter. So the basic idea with this teeter-totter, with these variables, is that the two sides have to balance by multiplying and dividing on either side. Not adding and subtracting, but multiplying and dividing. However much it goes down, it must go up. If it gets halved, it must double. If it gets quartered, it must quadruple. Getting it? If it only goes up 10%, it only goes down 10%. And that's that sliding scale. So the price is never really the price. You see it's $1 for a token, but even if you go buy one token, that one token will have slippage because that one token really matters to, well, there was 10 tokens in one side and 10 tokens in the other. When you added one token, well, that's 11. Well, we have to leave 9.1 in there. You only got 0.9 of a token. Wait, what? But it said $1 a token, and I only spent $1. Why didn't I not get a token? Because of slippage. Because the actual price is that division subtraction. So if you can see how much is in liquidity and go, oh, well, I'm exactly going to double that, well, then you know you get exactly half of what's in the other side. Doesn't matter what the price is. That's how slippage works. It's not really a big mystery. All right? So here, so all you do is run these calculations, half one side, the other side, keep your K constant, keep your price. So all four variables, I set them around a merry-go-round. And I can do roots, figure out the root price if it was at $1 based on the K variable, and from there I can half it or double it very easily. All right, now that we know how to do that math, moving along, my what if game. Yes, obviously I want to be signed in as me. The what if game, the non-financial advice that predicts more than one asset, because PulseX will be using the buy and burn. They started it, but then other community members, and you hate these altcoins, but the buy and burn links the price of an asset to its revenue producing. Everyone's buying these crypto. What do? They just sit there. These are businesses that produce revenue and are going to use that revenue to put it into the price as a friendly buyer. And people don't get this. This freaks them out because nobody's ever been that generous with the revenues of a business. This is how this market should have worked when it was built before the stock crash in the 1920s. Continuing along from this point, this that you guys look at is what I consider the front end, a nice little wrap up and summary where I can put in a couple of variables and we can put in different assets to look at them. So anybody in the community that has Richard Hart's values and uses the same tokenomics as PulseX got my attention. You don't want to pay attention to those videos? It's all right by me. I'm going to enjoy dollar cost averaging while the price stays low because you were too dumb to watch my other videos. I'm cool with it, you know? Richard says, smaller piece of a bigger pie, but I am broke. I would love a bigger piece. Why not have a little greed since I can imagine for once I might not have to eat Spam out of a can. All right. So this front end is not really where the math is. The math is the what if game. So in the math, I had to do a couple things first, which was figure out how many tokens were paired with how much USD value and what the price was. That's in the middle. What the K values were. That simple math I showed you. Then it was good to figure out the effective tokens in supply, which means I calculated 17.2 for PulseX. I believe this is actually closer to 12 for Pulse. Now, this is larger because the OA bought some. Has the OA ever sold? No. Does it mean they ever will sell? No, not necessarily, but when doing any considerations, it has not been an issue. It's impossible to calculate what he might do. Why bother? Those coins are likely to never move, in my opinion. So that's what I did. I ignored them, the OA accounts. So here I look at the different fees collected by revenue generating assets in these. And then I look at the amount of buyback burn scaled in different assets. How much are they using? Like, all right, this is great. This gives me some numbers. This was for me comparing liquidity pools, so I could try and figure out a way to uh, what is it when you group batch send? I wanted to batch swap if you could and split the ratios. So if Uniswap version 3 was say 3 times bigger than Uniswap version 2, 3/4 of your buy goes to 3, 1/4 goes to 2, and the price moves equally on both. Arbitrage, better luck next time. That's my big plan for arbitrage prevention, but I got a lot of bottlenecks, so I'd rather just get it out there in the community. But we're not here to look at that math. That's even more complicated. We're trying to keep it at where I started, with a few energy drinks and a night of anger at Excel. So once I figure out these base things, okay, I make this model up here where I can take the daily volume of, say, Uniswap, the portion of the revenue, calculate what that is out, figure out the portion that gets used for the buy and burn, which is just that per day, and then figure out a 1 year term. That is the amount of pressure that average would generate in an entire year. Oh, all right, now that I have these numbers and a working idea, I can now take my little values of tokens X, Y, K, and P. Yeah, the constants in price. So what is this here? Well, this is an if statement. This was just programmed based on which thing I set it to is which one it'll have to start with this. Same with here. Once I have the starting LP size based on which project I've selected, it calculates the K number, and then we have the price. So great, now that I have a theoretical liquidity pool to start with, this is where the chaos starts. This was simple on the one side to put in the value, but for me to figure out the tokens, do you see the equation that I had to build for relations in order to get this to pump all the numbers in? I'm not even going to explain that because everyone will fall asleep. This is why I talk like I've been shot in the head like an idiot, because if I really explain my stuff, most people fall asleep or make fun of me. It really isn't fun. And at the end of the video, I'm going to talk about Minkowski's time space diagrams. That should give you an idea, because that's the put you to sleep portion. Continuing along and ignoring this long fancy equation just to generate what that initial buyback burn is going to look like. I need to get unselected here. What did I do? Undo something here. There we go. All right. So then I figure out my initial split of 1 month worth of buy and burn, what that average would equate to. Once I know what that is equal to, like, here's the amount of value that went in through 1 month, how many tokens did that actually take? I had to use to figure that out. Then all I have to do is subtract this. We'll add that value to that in the LP and subtract the tokens. Now I have my new LP to start the next month. I rinse and repeat the process. Now you guys notice coins purchased and invested up here, and sold and profit. I have these in yellow and in white because I can go ahead and add data to this. I can add inside and outside market pressure averages for the month. So I can track from start what's going on in my model and see what the buy and burn pressure is going to do over time once I've established some averages over the first month. Oh, and on the side, you'll notice, ignore kind of half that math. What really was important was all these tokens here, every time they get bought off and removed, I did create a running tally of these, because every time these tokens get removed, they get burnt. So all I had to do was add all the token buys on average, which is how I came up with the burn totals on my crystal ball. And I just do this again, month over month, year over year, and that is all there is to the crystal ball, really. And over here was just some more test math where I wanted to resolve liquidity pools, like I said, to possibly solve arbitrage. Because even though I have a day job, work full time, yeah, I single-handedly want to save crypto. No, I've walked into a community that's absolutely awesome. It's given me hope in my life, and this is where I do have a passion that I want to be able to return a little bit of that hope. Like, guys, people have problem with crypto, things that are slowing it down. It's like, hey, you know what? I'm not Stephen Hawking, but yeah, I am in Mensa. Okay, Richard Hart seems to tote that pretty proudly. It does count for something. Who knows? Maybe I'll have a thought or two that helps. So far, people are interested in this math. And yes, you'll be able to find this math on a very awesome, awesome website. And guess what, folks? Walrus from this website is going to be on my show tomorrow. Yes, Sunday, Sunday, Sunday. Oh yeah, come see Walrus talk security. Don't get scammed, don't get hacked. On my channel, live stream. Hopefully you tune in for that one because I'd like to really see you pay attention to some security exploits because I'm actually going to dive deeper into my tech knowledge with Walrus. It's going to be fun times. All right, so tune in, check that out tomorrow. I should be releasing details of when, hopefully as soon as I find out when he's got the free time. All right, so now that we've dove a little deeper into the math, I know you guys always want to see prices. I did promise prices, didn't I? So I should probably set that crystal ball. So I've been watching the amount of volume that's just popped in amazingly. So that first month, I'm thinking, although I'd been conservatively, so let's not pay attention to this green box. We're just going to pay attention to starting price and the number of X's like in month 1 and month 2. Excuse me. Because we have seen some heavy action. There was an over 8 billion day of volume traffic day. So just in the first oh yeah, that's with the LP size. I did find out I was using Hex's LP size. It's significantly larger on significantly larger on PulseX. That slows down the functionality a little bit, and people will be selling. So I do like to take that in, and it looks like really far less than 1% we're even hitting the market. So we're going to put in 0.32%. Wait, no, I need to make sure that's 0.32%. There we go. And all right, so 48x, even with the heavy liquidity, and that's that honestly, that's not the starting price. That's from the sacrifice price, because I had to estimate what the starting price was. So I'm just going X's from January 1st sack price rate of 10,000 reward points for $1. So 23x, 48x at that kind of bullish just from the buy pressure inside the system. And this even takes care of the sell pressure from the system. What this is not looking at in this theory is any buy pressure from outside investors once it hits the market to actually be purchased. Oh, yeah. That's my moon math for today. And you guys can see numbers just update when I change some of the variables around because I have made the math that complicated that I can scale the LPs based on what I see there. Okay. So where am I going with all this in the end? This is where I'm going to reach out for a little bit of help. So where I'm going with all of this math is into a place with Metcalfe's law and S-curve values, and I believe the Roger Bell curve. So basically, I'm trying to look at network growth and its value over time as network grows. This is a lot of boring Excel numbers. We're going to simplify it. The Metcalfe value law is pretty simple. You guys are going to hate me for this. You're like, that's not simple. But n times bracket n minus 1 bracket divided by 2 equals v. So that's simple. Okay. So you guys are like, what does this mean? 10 users. All right. Hit equal. Here's how you do the equation in Excel. It equals this variable times bracket. You have to take this variable and minus 1. So whatever it's set at, it's got to be 1 less. So it's multiplied by itself and 1 less. So 10 by 9, 20 by 19, 40 by 39, consistently, always multiplied by 1 less. And then, whatever that is, it's only half of that. Boom. Now we have the value. That's how you use Excel. So 10 users, the value is 45. 100 users, 4,950. That changes just a little bit. Let's try 1,000 users. Interesting. Okay. What if we go to 10,000 users? Getting a little more 9, but just can't get over that hump. Okay. All right, what if we look at some random number? Boom. What is that I just did? 4.7 million users? That is a really large value number. That's all well and good. When's Zambo? When's my Zamboni? When's Lambo? Like, how do I equate? What does that mean for me and my bags, my value, right? So calculating the value is really easy, but the network, when it gets large enough, this formula has to change because it doesn't exponentially grow the same anymore. Now, something I was looking at was I lost the file, so if you're a fan and watching this and sent it to me, please resend it. The Bitcoin Maxi had done a video trying to link literally the price directly with Metcalfe's law and did some scaling, but which, I mean, in the end, that's what I'm trying to do. I need to relook at his math, but I had this feeling because telecommunications networks derive this value by what they can charge a user because of how necessary it is to use that network. So now DEXs and wallets who charge swap fees, transaction fees, they're the ones that through revenue get to use that kind of telecommunications model to it. But there's more than that because the amount that people put into liquidity pools, which raises the price, does seem to correlate as well with Metcalfe's law, but not to the same scaling of divided by 2. So in my formula, though, this was me doing some crackpot stuff with small networks. Now, this is, again, an average. So, I mean, in this, you imagine that even if the amount of users equaled, say, this for a price, we're going to scale this to 20, okay? Or not even a price, but the amount of liquidity in a pool, the amount of value in it. So, to use this example a little easier, let's say 800 users get in on a project. Well, with that formula, it would indicate that there should be roughly $32,000 in the liquidity pool paired with the asset. That's the crackpot theory I have because I've noticed it in a couple of assets that basically the value divided by 10. So if 10 cents to the value point seems to be a correlation, that's interesting, but still that doesn't tell me the price because that's on one side. Like, I don't know if that's correct or if I have to adjust this asset to asset because what matters is how much other asset was it paired with. You know, maybe we'll call it count coin. 1, 2, all the way up to 6s and 7s. I'm not going to hurt you that bad. So this, like we talked about earlier, well, the price always equals the tokens divided by value, the value divided by the tokens. I should really do this right. Divided by tokens. Boom. All right, so cool. Let's look at the math a little more. 1,600. So we doubled the number of users. Well, that quadrupled the amount in there. And if that quadrupled the amount in there, well, then what we need to do, let's take this number actually. Move it above. Watch this, folks. This one is going to equal this divided by, well, since we quadrupled 4, Boom. And that's what the price in this fictitious asset might have theoretically shifted to because of the increase of users. Now, the interesting thing with this, we're going to go ahead and set this back for my theory because a couple people will know where I'm going with this because of what asset I'm probably looking at. All right. So the interesting thing about scaling this is, okay, was it just this pool and one other pool I was looking at and the third pool I toyed with that were on here? And even with this, with 800 users, is it always at this value? No, it's been ranging between 28 to 35. But this is kind of like an average that's been falling at. So I don't have the time, since I have a day job, to check liquidity pool after liquidity pool after liquidity pool at Uniswap Analytics. It's that simple. It's easy to go to. You go to version 2 just like this. For some reason, Googling version 3 isn't easy. But you know what is easy? Go to version 2. You can look up what's there, and then when you're done, just change the 2 to a 3 in the URL. So I can go here, look up pairs, look what's in here, but I haven't been able to say look and try and find averages and really narrow down for the value in a network. Is there a linkage to the amount that should be in the liquidity pool, and what does it scale to? Is it 1/10? Is it 10 cents to the dollar, like it looks like to me? I don't know. I need some help on this one before I go any further with Rogers bell curve and S curves. I need to make sure I'm understanding Metcalfe's law, otherwise there's no point trying to predict the growth. Now, what you guys really probably want to hear at the end of this video is, here we go now. We're going to have a look at the markets as a whole, folks. Yes, getting into it. Let's bring the pain. We're looking at the SPX for the week. Now, as we look at the market indicators, we can see that the SPX has been taking a crap kicking pretty much all year if I stop getting all these ads. All right. So what do we have here, folks? What are we actually looking at? How do we scale this? All right. Well, let's go ahead. 2020. Let's look at the last 2 years. This might give you a better idea. Oh, look. Things were just getting really crappy, really crappy. The thing happened. And then the Fed started printing money. The Fed started printing money. The Fed started printing money. The Fed stopped printing money. Oh, did the Fed kick the can down the road for an issue that previously existed? Maybe. But can we do anything about that now? No, just hold on to your assets and be smart when you trade if you're going to. So how do we do these readings? Well, we can see red impressions on the MACD on the Instagram showing that the asset is in a swan dive formation. We have oversold conditions, which do indicate that perhaps there's a good argument for a bear market rally next week. It's going to really depend on what the Fed comes forward with, because right now the indicator is talking about a 0.5 point increase, but there are some hawkish guys talking about 0.75. So depending on their discussion and what random things they decide to spout on the news, it could completely crush the dead cat bounce or market rally that should occur in these market conditions. As you can see, this little bounce here was last week trying to do the rally, and then it just got crushed out, got spooked, and then flattened by earnings and the crazy stuff with Tesla and Elon Musk. So when you look at the NASDAQ and you want to compare, you see relatively similar kinds of volatility looking along across the last 2 years. Ooh, it is amazing how these charts have been manipulated. Now, the NASDAQ looks just like the SPX. Why? They're both indexes of companies. But the SPX 500 has 500, the NASDAQ 100, which means it has a slightly more volatile spread, but a lot of the same stuff. Then we have the Dow Jones, a more practical industrial mix of companies, giving you a different snapshot of the same market. And isn't it amazing how the market snapshots, the Dow Jones, you can see by this selective trading index, it is a little different. We actually don't have the direct correlation that exists in the SPX and NASDAQ, these larger indices. And that's where I've noticed the correlation with Bitcoin and keep harping on, hey, if you can see what's happening in the market, you might actually have an idea what's going to happen in Bitcoin. Then you've got the VIX and the DIX. So the VIX tells you the volatility indicator for the SP 500. What you want to know about this is when the volatility is low. When the volatility is low, folks, it's probably a good idea to open up puts and calls. If I'm understanding this right. I don't do margin trading. So the VIX indicator, it usually, as you can see, goes in opposite from the rest of the market. However, the DIX, dollar index, US dollar index, usually is going with the VIX, volatility wise, opposite of the market trends, or the market's going up and they're going down. Usually. However, in the madness that the Fed has instilled in the markets, there has been days where it's all red or all green. Or things like they've been going opposite of each other. It's been starting to look like absolute madness. And you can see off to the moon as the dollar's gaining strength because it's getting really strong. No, every other dollar and currency on the planet is just getting weaker faster. Yeah, folks. So that's the layout. So here you can see that the dollar index, if you're doing the forex exchange or you're actually getting into this, there is a pullback on the dollar. Now, if we actually want to see the Fed raise interest rates and want to see the dollar really actually recover, that's what all this bullishness has been: is the stock market hurting, the dollar recovering as the Fed is raising interest rates. That's kind of what they have to do. They have to go full Volcker and crush the stock market. Now, I like to keep a look at the big tech movers. So Apple usually actually has very good valuations. They're pulling a stunt and spending another $90 billion in their own assets to try and pop up the market, which is just going to flush money down the market when they could be spending it on R&D or providing more jobs to actually stimulate the economy. But instead, they're going to go for a fast cash grab, so the executives who didn't cash out back in December when they were told to can have another chance to get out before the pain really hits. Now, Apple's got pretty decent valuations. So I like to keep a trap on that, because when Apple starts to hurt, that's when the pain's really coming in on the market. And we're starting to see that it looks like it has topped out as of this year. We have seen top, try to, no. ABC pattern, rally. This is where I was talking about the market, what I expected to happen in Apple, an actual stable product. And we're coming back into crash territory. Tesla, I love this. At its all-time high, when I told my friends to avoid it, 1240, when I was really screaming like this is endangered territory to more people, it's been hovering around these numbers like, get out. This is a top. Yes, I call it the top on Tesla. I believe in my videos. And for my friends. Yup, I gone and done told you. So, again, we had the dead cow market rally rants there. Whole bunch of... it's basically the mom and pop investors, your retail investors. The smart money got the hell out. They're just diving in, buy the dip, buy the dip. All right, so again, we've got oversold conditions. We've got that red impression on the Instagram, and we've got pain in Tesla. Why? Because of the tomfoolery going around with Twitter and Elon Musk just parading around. They have finally woken up the FTC, which is the FCC's cousin. So financial transactions are going to be under review for Elon Musk, Mr. Reverend Musk, Maverick of Wall Street. I love you, man. Great content. So basically, Tesla is in for some pain because it's leveraged right now for Twitter. And Twitter's stock is feeling some pain. Now, the only safe side in this is Elon Musk does have a parachute condition where he can pay $1 billion to say, oopsie, I changed my mind. And he can run away from this deal. But right now, he is linking Tesla very heavily to Twitter, which has never done well. And will he revive a social media platform? Well, look at history. They're not really that easy to do. Facebook and Twitter got lucky, basically. So has Netflix. Or not Netflix. Netflix has gotten very unlucky. This was up almost $700 back in November when I bought Hex. And that's right. If you were listening to Jim Cramer, you didn't buy Hex. You bought Netflix. I bought Hex, and I'm up. You bought Netflix. Listen to John Cramer. Buy the dip, buy the dip, buy the dip! All right. So we don't care how oversold this is. A market rally this is still not even all the pain Netflix has to suffer. They have horrible earnings. They're burning their cash. They have ruined their model. They have Stranger Things, and that's in its last season. I know I'm planning to cancel my subscription. Then what else am I looking at in the markets, folks? Well, I've got my futures: silver, gold, oil, natural gas. What is the really only thing that matters in all of this? It's the oil. It's the oil. Because people want to know, are we in a start market crash yet? Or or is it coming? Or has it already begun? Well, when you have inflation being crushed, traditionally, you see these big dips in oil, inflation, 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 crushing price before we had economic crush. So oil's a lead indicator. When the price in oil comes down, inflation is finally going down because economic slowdown and demand have finally been crushed and the market crash is coming. So when we're looking at this, we're not overbought or oversold. This could be a bull flag step up, a consolidation to head even higher in oil prices, meaning there's more inflation to come, more in the economy to kick out, and the stock market crash isn't even here yet. But this could be the top, and this could be an ABC pattern as we're stepping down. I'm not going to bother with Fibonacci levels and lines on these charts, but this is basically the oil, that price is the indicator on whether our inflation is continuing because we still have an economy, or whether the crash is imminent because demand has been crushed by the Fed. In here, I do like to keep pace on some of the currencies: European, US, Canadian, obviously where I live. Then my cryptos. So as I've said, Bitcoin, when you actually look at it now on a shorter time frame, the correlation directly with Bitcoin happened, boom. It happened pretty much right here at the end of the year. Bitcoin started to correlate with the SPX, which is why there's been a lot of pain. And again, we've had dead cat bounces, but we're not heading back to all-time highs. It's not to the moon, folks. It's coming down. And it's been dragging Ethereum with it. Oh, doesn't that look identical? Oh, that's creepy. Isn't that creepy? That's what market correlation is. That's what market correlation looks like. And that doesn't look quite the same. I probably have to back up a little further. But the downtrend and the hump is where, like, I noticed the correlation forming in February between Bitcoin, this downtrend, and its hump. So it looks like maybe it's actually finally snapping out and doing its own thing. I'll have to double check the market correlation thesis. But in the meantime, Bitcoin and Ethereum, well, there's no argument in that correlation. But Hex has finally broken that correlation, and we have broken the long-standing trend of resistance. So we are now in a bull market. We have broken the bear market, and we are beginning the bull market in Hex, folks. Congratulations, it's finally here. Oh, but don't worry, the pain is coming to other assets. Luna, I really thought this should have been the top. I was surprised when there was one more crazy pump, and then it started foddering out. You know, I'm not perfect. Oh, BNB, that looks familiar. Didn't we see that downhill in a hump? That's Bitcoin, in that Bitcoin. Oh, yeah, that's Bitcoin. Okay, so good to know. I bought Bitcoin, I bought Ethereum, I bought Hex back in November, and it'd all be in the exact same place. But if I bought Hex in November down here, I'm actually up. And that's actually the case. So congratulations, folks. Oh, Hedron, you guys might see that on the bottom. Basically, this is, no offense to Hedron, dump coin. The Hedron business model is cool because you can take an NFT, of your Hex stakes. You can create a bond using NFTs. That's awesome. But then they made a coin and free dropped it to any and every Hex stakeholder throughout eternity. So you can go create a Hex stake, sit on it for a year. Just before you claim it at the end of the year, for the amount of days you've claimed it and the size of it, you can go claim your Hedron. And then you can go sell it on the market. And sell it, and dump it, and sell it, and dump it, and sell it, and dump it. So will it get more buyers than sellers? Ever? Don't want to knock on you guys, but you burn mechanics. Maybe I'm not understanding those enough, but You got a lot of sell potential into that system. Not seeing all the buy potential. But that NFT hex staking, mm, mm, love it. That is some forethought and thinking. So, I mean, I love to see what else these guys do come out with. They are thinking a better game. Maybe I'm not getting the tokenomics made. Like, there is something where, along a longer time frame, this might be a sleeping giant where, while Pulse Chain goes nuts for a few years, when it slows down in growth, Hedron might go, hey, you've been ignoring me this whole time, and then suddenly might have some growth. So, I'd have to admit, I spent $14. Okay, generally, if I wasted that at a night in the movies and hated that movie, like I've wasted money on worse things. Yeah, yeah, you know what? I can spend it on this asset and watch the chart for a night and talk to the people in the group. It's slightly more entertaining than some bad movie. Yeah, all right, all right. So that's my value right there. If I never saw a penny, no, I went socialized in a group, being like, yeah, cool guys. I bought some $14. But yeah, I'm a part of, right? So this is now you're seeing overbought conditions in the RSI, and you're seeing green impressions in the Instagram, which is again partials of the bull run starting. Now, with all this excitement, you can see this happening right now. We just had a big run up. It's time for a little correction. You see over here, we had a big run up. We got over that line of resistance. We needed to correct back down and then run up. So are we going to come back down and touch this? There's a good chance. There's a good chance we might come right back. Okay. Stop recording. Recording. It looks frozen. Don't know if this is actually recording anymore. Alright, folks. I'm going to have to go back and rewatch that ending. Awesome. My computer lost power while I was trying to get this done. So, hopefully I didn't get caught swearing on this video. I will double check that at the end here. Point of this whole thesis is, yes, Hex is about to do great. We're probably going to have a little correction back down to 16.5 cents, maybe. And then we've got some freedom to move up at least 27 to 35 cents. There's not a lot of resistance here, so we should see a good match run. That's what it feels like. The conditions are right. The liquidity is low. The volume's picking up. The rest of the market sucks. So come hide in Hex. Really, this is a great place to store your value, keep it safe, and get rewarded to do so. Thanks for tuning into my channel and listening to me rant for almost 50 minutes. Try and jam some knowledge down your throat. Hopefully you enjoy the content, the concepts. So yeah, if you made it all the way to the end, smash that like, smash the comments, leave some for the algos, subscribe, all that good jazz. But yeah, do not pay attention to the wallet address in the descriptions. If you watched last night's video, you know what I do with money. You definitely don't want to send money to me for content. Because I'm not a financial advisor. I'm a crackpot.